Hey everybody, welcome to the June 2026 market update. A little bit of mixed data this month. I think the thesis still holds strong that the market is setting itself up for a recovery of sorts over, hopefully in the foreseeable future, the years to come. But there is some mixed data, some headwinds, some things for us to pay attention to as we move forward. So let's dive right in. As always, we're looking at the 5 county area, Wake, Durham, Johnston, Orange, and Chatham counties. New listings and closed sales were up in June. So that's great. 3.7% for new listings, and then a whopping 14.4% higher over last June for closed sales. So year to date, both of those numbers are looking really strong, up 5.5% for new listings through the first half of the year, up 5.7% on number of closed sales through the first half of the year. Great metrics. We need to see those listings continue to go up so that we can have the closed sales. I don't think it's any secret that there's a lot of demand for housing in our market. So if we can have enough good listings on the market, enough options for buyers to choose from, then we should continue to see healthy churn in the market with those closed transactions. Through the first half of the year, almost 22,000 new listings hitting the market, almost 14,000 closed transactions. So that's roughly 28,000 transaction sides. The median sales price was flat in June at 465,000, and year to date it's flat. Year to date median price at 450,000. So you see that discrepancy there, of course, because median sales price tends to be higher in the spring and summer months. So that's why you'll see that there when you're looking at just one snapshot of a single month. We still see with sales price to list price ratio, still a little bit of negotiating room. We're seeing some houses that are selling above asking price, some that are negotiating down significantly, but still in kind of a healthy range there, 98, 99%. Total showings were actually flat. So this is the first time we've seen this happen probably in the last year, or at least close to a year, where we've noticed that showing activity had been picking up since at least last August, possibly sooner than that. Started tracking that last summer. And so this is the first month that we've seen year over year data be really flat for number of showings. So that's an indication of what we can expect moving forward. Now, new pending sales were up 5%. So that's great. That's a good indication for what closed transactions should look like in July and August. Hopefully going to see healthy numbers there. But the showing activity falling flat, especially when we saw new listings going up, means there were properties out there for buyers to look at, but for one reason or another, it's the number of showings stalled. Now, in the summertime, it just stalls anyway. People have lots of other things going on. Kids are out of school, vacations, but we are measuring this against last June. So all of those dynamics that would cause a slowdown in number of showings compared to, say, May, for example, those were all in play last year, just like they are this year. So sometimes that can have to do with weather and different things can impact that on a 1 month basis. So we will continue to watch that, but it is definitely worth noting that showings were flat in June. Now, inventory is up 6.8%. Again, a healthy number, a really kind of a slow growth, actually, when you think about the fact that we need more inventory. So we were 8,419 homes on the market compared to just under 7,900 at the same time last year. So I'm glad we're moving in that direction. We do need that. And we don't want to see it spike up. We don't want to see inventory come down. So I'm very happy with that. Month supply is aligned. This says May 2025. That is June 2025. So inventory levels about the same as they were last year. Now, when we look back, as I like to do, at 2019 and compare our current numbers to the most recent time period before COVID, because as we know, COVID had an impact on our market that is obviously having an impact for years to come. Even after we've recovered from that shock, there are changes to the way our market works that are lingering. So I like to see where are we relative to that as we hopefully try to move back to whatever, quote, market norms are. But you can see we actually surpassed the inventory level that we saw in June 2019. We've been working towards this, and I've been telling you for years now, actually, that we need our inventory levels to surpass those levels we had in 2019. For those of you who were selling real estate back then, there was not much inventory on the market. Way more buyers than we had houses to sell. It was difficult to find the right homes for buyers back then. So we still have plenty of runway to go. I think it's actually a good sign for the health of our market that we are finally, or at least for 1 month only, so not to put too much weight on that, but for 1 month at least, we have surpassed that 2019 inventory level. So we'll continue to monitor that. Now, the median sales price back then, if you can believe it, was $296,000. And when we apply what I'm calling normal appreciation onto that price, and we extend that out to where we would have been today, okay, in June 2026, if we had not seen the price spikes that we saw during the COVID years. So if we apply that straight line, 5.5% appreciation, that lands us at just between $430,000, $431,000. Now you can see where we are in June. We were at $465,000. So we are still ahead of where we would have been if we had just seen that straight line appreciation. But what you look at here is if we see prices stay flat for another year, then prices will be exactly where they would have been if we had never had that price spike thanks to COVID. And of course, you can see here we are, prices are flat this year. So if they're down 1%, up 1%, somewhere in that range, that's a really healthy place for us to be for the next 12 months. I think if we are looking back next May, June timeframe, and the median price is still in this neighborhood, then I think we are really poised for a healthy next decade of sustainable, healthy growth, barring any, other major macroeconomic or global influences that, of course, are going to, change what happens with the real estate market and the economy. But we are finally at a place, or getting closer to a place, where the consumer believes they are getting enough value for what they're paying for when it comes to housing. And so it took us several years to get there, but we are finally approaching that, where when you go look at a $500,000 house, the consumer says, yeah, that feels like a $500,000 house. So that's a great, healthy place for us to be. That was not the case in, say, 2022, 2023. So we've persevered through a difficult few years. And again, it looks like we're starting to come out the other side. New listings back in 2019 in June, 3,800, which again is right in line with where we are this month. So again, the number of new listings coming on the market, that is a healthy place to be. Where we really see that discrepancy is the number of closed sales. So 3,567 back in June 2019, only 3,062 in June of 2026. So we're still well behind the 8 ball. We had 17,000 closings year to date back then. This year we're just shy of 14,000, so more than 3,000 transactions, closings, short of where we were 7 years ago. So that's really the number we're chasing, is trying to get that churn back into the market with more of these transactions happening. You can also see new pending sales, almost 3,400 back in 2019, and only we're shy of 2,700. So, you can see that we are going to likely be short when it comes to July, August, September numbers for the number of closings. But as I've talked about for a while now, what we want to see is movement in the right direction. We know we're not going to bridge this gap of number of closed transactions we're seeing overnight, or in 1 month, or even in 1 year. I don't expect to see that gap being bridged even in 2027, but we want to see continued movement towards year over year gains for a number of closed transactions. The fact is, there is no lack of demand in our market, so there's no reason why we can't be moving beyond 2019 numbers as things get back to equilibrium and kind of a normal market. Now, of course, a lot of that is going to do with where mortgage rates are. So we'll continue to monitor that as that affects housing affordability. As you can just see here, though, quickly, the green line represents this year, 2026, and these are our inventory levels. Great trajectory going up, and actually happy to see that we surpassed the 2019 levels. I am making no predictions about where this goes the rest of the year, but the fact that we have continued to approach the 2019 levels and now surpass them, that's a good sign for the future. We need inventory in our market. More on what that feels like for sellers right now in just a couple minutes. This just shows our year to date new listings. And again, we're trying to bridge this gap between the green bar here, which is 2026, and the blue bar, which is 2019. Just shows we are seeing a proper trajectory right now in terms of number of new listings hitting the market. So that's looking good. Closed sales, again, we started off the year not great in terms of being behind 2025 numbers, which was, if you were watching in January and February, those were surprise kind of numbers coming in. But then we kind of hit our stride, and you can see we are surpassing the 2025 numbers on a monthly basis consistently. And you can see these are the year-to-date numbers, and we're starting to see that margin between this year and last year continue to increase. Again, up about 5.5% over last year right now. And then new pending sales. Again, the trajectory that we're heading is very normal. We want to continue to see more gap between last year and this year, which is the green line. And we want to continue to see a reduced gap here. But the fact is we are tracking in a similar manner to what we would expect. We just want to continue to approach those 2019 numbers, which will happen. We'll see this go lockstep with closed transactions. The real question will be, as new listings continue to hit the market, as inventory continues to climb, do we see these new pending sales climb as well? Or do we see this moderate, which means more pain for sellers? So time will tell. Speaking of pain for sellers, this new listing to closing ratio, this is something we look at each month. And the further we get along in the year, the more relevant this current year's numbers become. And what this basically tells you is, how painful does it feel for a seller in the market? It doesn't tell you what it feels like to be a buyer or a real estate agent for that matter, but it kind of gives you an indication of what's the pain point for a seller, because this is how many listings need to be taken in order to sell one. So you need to take 1.57 listings in order to sell one listing. Since you can't take a fraction of a listing, though, think of that as you need to take 16 homes need to hit the market for sale in order for 10 of those to actually sell. So that's 6 sellers right there who are unhappy, 6 listing agents who are stressed out trying to figure out how to get their house to move. And it's also an indication that when there are more homes not selling, then prices need to come down. So we are in a market where we have certain areas where prices are going up because there is high demand. Those homes sell quickly. They sell for over asking price. But other markets, especially the further out from Raleigh or Cary that you go, the more likely you're going to have price reductions. Your home is going to sit longer. And so these 6 sellers need to figure out, how do they get their house to sell? And oftentimes that means a price reduction. So it doesn't feel great for those sellers. And if any of those sellers are ones who bought their home within the last few years, it's probably going to feel even worse, because it's very likely they could be selling their home for less than they paid for it. All right, last 2 things I'll show you are about housing affordability. This is some of the headwind we have right now because of the conflict in Iran continuing on as I'm recording this. That conflict has kind of renewed strength right now. Oil prices are going up. And even though in the most recent reading of inflation was down significantly, it's still elevated. And the headwinds that pricing and affordability are facing right now mean that this index may not improve a lot. So we saw the number going up in the second half of last year, peaking at 97 in January, and that seemed really good, hopefully leading us into a really great spring. But as the oil prices started to shoot up, which caused overall inflation to shoot up, that really then caused mortgage rates to go up, which really pulled the brakes on what was happening in our spring market. So even though things weren't terrible and we are up year over year, we are not up probably where we would have been if we could have had mortgage rates staying closer to 6% or the high 5s that they were trending towards before the Iran conflict. So we'll continue to watch this. But if you just look at the chart here, again, we've made some progress since last year in terms of housing affordability. But we are currently trending in the wrong direction the last few months. So we're going to continue to monitor this. Don't have a crystal ball, don't know where it's going to go. But again, there are a lot of fundamentals that I think are setting our market up to have a solid recovery. The fact that prices are holding firm as a market rather than coming down, and they're certainly not spiking up, I think that's really healthy for us. if we can get some kind of predictability in the mortgage rates, I think that's going to help buyers with making buying decisions. And we're going to be positioned, at least in our local market, to hopefully have a good several years ahead of us. So thanks for watching. If you have comments, thoughts, perspectives, please put them in the comments below. We always love to hear what our watchers and viewers are thinking and seeing out there in the market. And until next month, take care.